Hello and welcome to the channel. In this video, I'm going to explain how to build generational wealth for your kids. So let's get into how to do it, and it starts with 5 factors. 5 factors. Strategy is the first factor. You need to have a strategy in order to do that, and I'm going to share a potential strategy with you in this video. You need to have discipline to stick to that strategy over a long time, yourself, but also your kids at a certain point. Tax efficiency is going to be important. You will minimize the amount of tax you're going to have to pay because that could eat into your return significantly. Also, cost minimization. You want to reduce kind of trading and transaction fees because that will eat into the return. And then the fifth element is time. Now, time is kind of a function really for compounding. The longer period of time that this can go on for, that you can employ the strategy, much greater the result that your kids would ultimately get at the end of it. The compounding underpins everything, and we'll go into the detail in a minute. So just before we start, nothing here is personal advice to you. And of course, do note that tax rule can change at any time. Also, do stick around to the end of the video because I've got a massive warning at the end of the video that will probably be relevant for most of you watching today. Keep an eye out for that. But I'm now going to go into a diagram on screen, and that diagram will demonstrate potential strategy for you. Let's have a look. So we'll fill in the detail of this diagram, but this is the generational wealth plan for those of you in the UK. So there are 2 strategies or 2 elements to the plan, and I'll detail the actions and inputs on both those, so how to get to the end goal. I think the key things to note is first part of the plan, you want to use retirement savings. I'm looking at a self-invested personal pension here in the UK, or a SIP, you may hear it called. Now, what is a SIP? Let's bring that up on screen. We're going to start with a junior SIP. Junior SIP is effectively the parent opening a pension account for a child. They can pay into that until the child turns 18. They're in control of that. At that point, the child is then in control. Now, with a junior SIP, these are the key facts for later on, there is pension tax relief. You get 20% added by the government pension tax relief. Now, the second tool we're going to use is a junior ISA for the second part of the strategy, and that is essentially the same as an adult ISA but for kids, and the parent controls that until the child is 18. The reason I've kind of got 2 strategies is because I want to give flexibility to your child or future children. So with the pension part in leg 1, and we'll start filling this diagram in a second, that money can't be accessed probably until 57, may even be later than that. Whereas in part 2, the money can be accessed from 18. So by putting money into both, there is an element of flexibility. So let's get into the detail of the plan. So here is what I'm calling the 7% generational wealth plan. And it's called 7% plan because it assumes a rate of return after fees and costs of 7%, which is relatively modest, relatively achievable, I think, over a long period of time. We start off with SIP going on the top. So your child is born. Your action would be to open a junior SIP account, so pension account for your child. Immediately start adding in £25 a month to that. You get £5 a month from the government in terms of the top up. Now keep those going, keep those payments going. And when you get to 18, let your child to then start making those payments, and that should then accumulate over time. Then get to age 57. Current legislation that could change, of course. I expect it to be higher, let's say 57. Now, as you build up to that, at 18, it's only £13,000. 40 is actually £79,000. And you get to that 57, it's £271,000 just from adding £25 a month, growing at 7%. It's compounded for 57 years, incredible length of time. You're over £250,000. Now, at that point, you've got 2 options. You can carry on, child can carry on adding and not take anything out, or indeed, they could take their 25% tax-free amount. They could take a £68,000 tax-free amount, still have over 200,000 in the account. Now, if they carried on until the retirement age, if they were born now, which would be 68, they've got 2 options. At 68, they've got, or 2 scenarios, they've got 590,000. They've got 590,000 in the pot if they didn't take the tax-free lump sum at age 57, or indeed in the intervening period. So 590,000 using a special rule, we're going to call the 4% rule. Now, the 4% rule is shown here, which is if you set your withdrawal rate of 4% of your retirement pot, adjust it for inflation, basically means you won't run out of money for 30 years. So 68 might take you to 98, and that should cover the vast majority of people. So we'll divide that pot by 25, i.e. 4%, and that will give us the amount of income or withdrawal taken each year. So on that 4% rule, pot of 590,000 will give around about £24,000 income. So you've already got £24,000. Now bear in mind that the UK national average wage is about 28,000. Full time it's 33,000. If you've paid off your mortgage at that point, being one of the aims, then actually you're not too far away from the equivalent of earning the national average wage. But of course, it will be a pension, so you won't be working. You have £24,000, well, that will be taxable income. Maybe that'll be about 20,000 after tax. Now, the other option is if you did take at age 57 that 25% tax-free lump sum, take that 68,000 earlier, you'd have 444,000 or so in your pot. Your taxable income would then be 18,000. You've got a decent amount of income from just paying in £25 a month from effectively from age 0 to age 68. That's incredible in my view. That's generational wealth, £500,000 or so just from the pension side of things. And of course, really good, interesting notes come out later around how that affects inheritance tax. Now, the second part is that flexibility in the ISA, and it also is the tax-free option. So again, your child is born, you should open the junior ISA according to this plan, and add £25 a month into that junior ISA. And then they could access at age 18. Of course, over that time, if you want to build a big amount of money, you kind of trading them, educating them, and at age 18, it's £11,000. I know a lot of people at age 18, they said, here's £11,000 tax-free. A lot of people would spend it. They use university, might buy the first car, might just spend it. It's a lot of money at that age, but actually it's not much, grand scheme of things. Because that £11,000, if you carry on the £25 a month, so the child picks up when they get to 18, they start paying in £25 a month. 7% return after fees, they get to age 40, it's 66,000. But then, age 57, they're up to 226,000, and you get to age 68, it would be almost £500,000, £492,000. So 68 years of compounding £25 a month, that's £300 a year, 7%, almost £500,000, and it's all tax-free, no capital gains, no income tax, no nothing tax. So that's effectively £20,000 per year tax-free income using that 4% rule. So using this generational wealth plan, you have spent, one child, you spent £50 a month for 18 years. So that's £600 a year times 18, not a huge amount of money. They've then continued that £50 a month between the two actions, and they've got over £1 million, of which just under half of it, let's say, is tax-free, and the other half, just over half, is in pension pot. That's incredible. £1 million from nothing. It's achievable if it started at the beginning because the amounts of input are so low. And it's using those great products, the junior ISA and junior SIP, then transferring into normal ISAs and normal SIPs upon the child reaching adulthood. Now, there are some key notes to add. The key notes are mortgage should be paid off for retirement, reduce your income needs. Of course, you could, I suppose, use some of that tax-free income to pay it off at 68, but ideally it's paid off before then. We know that the rules can change any time as well. Now, the other question you should be asking is, how do I get this 7% return post-fee consistently over a long period of time? And that for me would be through index trackers. The S&P 500 over a long period of time has consistently achieved more than this return, for example. With the index trackers, it's very low holding costs, low to no transaction fees, minimizes your risk, and it's very passive, so it's minimal impact. That's the way that I would do that. Now, I'd suggest looking perhaps starting at Hargreaves Lansdown as the provider for these. I'll leave links below, but there are other providers as well. I do use several brokers, including Free Trade, Interactive Brokers, as well as Hargreaves Lansdown. So I'll put some links below if you want to look at those products. Yeah, some of those will be affiliate links, and be very grateful if you are thinking about these products instead of using those links, because it helps me out and helps me then to keep producing these. Now, of course, you might want to accelerate time here. We might want to increase the value of those numbers that we looked at. Could get a higher investment rate of return. So you start pushing beyond 7% over a long period of time, that gets harder and harder to do. Might put more money in, which is particularly impactful in the early years, where those increased numbers have more time to compound. The unnamed child, when they get to 18 and they start working, they might pay themselves first. You a great rule. They might put 10% of their salary each month, if they're an employee, into the pot, and that again would accelerate the process. And of course, on pension, if they're earning a lot of money, they're putting money in, they may get high rate tax relief because the 20% is the basic rate tax relief. If they're paying 40 or 45% tax in due course, they can claim more tax relief, which would mean more money into the pension. Very important warning, you must start doing this as soon as possible if you want to follow a plan like this. Is that I started child is born at age 0 effectively. Now, if you start at 18, so you're really super organised and you start investing at 18, which would be much earlier than probably 95% of the population, right? Did your £50 a month total contributions, which is what we're talking about in this plan, instead of the circa £1 to £1.1 million pot across the two strategies, you'd only have £300,000. So that would give you your £12,000 of income instead of around about £40,000 of income. So that's a massive difference, and it wouldn't be enough probably in your retirement. So starting earlier is better, but even if you're super organised, start 18, £50 isn't enough. You're going to need £200 a month in order to get that same output because you're starting 18 years later. You need to put 4 times as much in. And if you start at 30, which again, a lot of people aren't thinking about pensions at 30, but you might be starting that, start doing this at 30, you've got a lot less time. And if you just do the £50 a month, your pot size is just £125,000, 8 times lower. £5,000 a year income. Not want to touch the sides, right? So at this point, you probably need contribution around about £475 a month to hit the same pot size. So £50 a month if you start born, or rather your parents start on your behalf. £475 a month if you start at 30, which again is earlier than a lot of people start thinking about this stuff. So the message is clear, though not financial advice. The general message is start as soon as possible if you can afford to. Do it now. Do drop me a comment below if it's inspired you to start junior ISA or junior SIP for your kids to build long-term generational wealth. Make massive benefits to them as they get older. And do click on screen now because my attempt at generational wealth to build £1 million, share my portfolio, my stock market portfolio with you every month. Click on screen to see how that's doing and whether I'm on track